Okay, we're good.
Okay, so hi everybody. Today we are going to talk about international payments. On the agenda, we have non-resident aliens, resident and non-resident alien taxation, tax treaties, purpose of Form 8233, Form 8233, impact of visa status on taxation, the expatriates, and resident aliens, foreign earned income exclusion, expatriate taxation, totalization agreements, Social Security and Medicare taxes, employer tax reimbursement policies, currency conversion, and managing international relations. So resident versus non-resident aliens. The resident aliens are taxed on their worldwide income, and their employers treat them the same way they treat US citizens. Wages paid to the US are subject to federal and state income withholding and employment taxes to the same extent wages paid to US citizens. Non-residents, let me just move that over. Non-residents are taxed only on their income from US sources, with some exceptions. But generally, foreign citizens working in the US are considered non-resident aliens unless they qualify as residents. The Internal Revenue Code determination applies only to the alien status for US income tax purposes and not for immigration or other federal and state tax purposes. Their status applies for the entire year. Some days do not count when determining residency. Teachers that are here on a visa, medical conditions that occur when they're in the United States, professional athletes, and there's others as well, but those are some key ones. Lawful permanent resident, this is the green card test. So they're considered residents for income tax purposes only, because the lawful permanent resident test is based on the alien's legal right to work in the US, not on the alien's physical presence in the US. The green card holder is treated as a US resident until the status is revoked or abandoned. Substantial presence test gets a little tricky. The alien is considered a US resident for income tax purposes if the alien is present in the US for at least 31 days in the current calendar year. The total of numbers of days in the US presence during the current calendar year plus a third of the US days during the first preceding calendar year, plus a sixth of the US days during the second preceding calendar year is at least 183. You can't round and fractions have to be used. We do have a couple of good examples here. Francois, a French business executive employed by a US company, is present in the US for 132 days during 2020, 110 days during 2019, and 86 days during 2018. To determine his status for the current year, Francois counts all 132 days in the US, plus 1/3 of the 110 days, which equates to 36 2/3 days, and then a sixth of his days in the second preceding year equates to 14 1/3 days. So that gives a total of 183 days. Therefore, Francois meets the substantial presence test, and he is a resident alien for 2020. Maria is a Brazilian employee for a US company, is present in the US for 20 days in 2020, and was in the US all of 2018 and 2019. But because she was in the US less than the 31 days in 2020, she is not qualified as a resident alien under the substantial presence test for 2020. So she would continue to be a non-resident alien. Taxation for resident aliens. Sorry, my cord is hung up here. Employers must withhold and deposit federal income, Social Security and Medicare taxes, as well as state and local taxes, and disability and unemployment taxes where required. They must also pay the employer's share of Social Security, Medicare, and federal unemployment. The Immigration Reform and Control Act requires completed I-9s and W-4s for all of those employees. Resident aliens working abroad for a U.S. employer are generally treated the same as a U.S. citizen and are entitled to the same income exclusions. Wages paid to and taxes withheld from must be deposited and reported by the employer the same for all other employees on Form 941 and W-2. So it's nothing separate. It gets reported the same as every other employee on the Form 941 and on W-2. Sorry, I need a drink. Non-resident aliens are subject to the same federal income tax withholding requirements as other employees for all of their income from U.S. sources that is not effectively connected with a trade or business that they are operating in the U.S. The Immigration Reform and Control Act requires completed forms W-4 and I-9. As a non-resident alien, you cannot claim any exemptions, excuse me, or any child or dependent tax credits. Must file single regardless of the marital status. That's really important to know if you do have any calculations on your test, because it'll say somebody is married with however many dependents, but you have to treat them as a single person with no dependents. They must write NRA, non-resident alien, on step 4C. Wages paid to and taxes withheld from must be deposited and reported by the employer, the same for all other employees on Form 941 and W-2. Pop quiz. When non-resident aliens complete a 2020 Form W-4, they must do what? Check the box in step 2C, check the single or married filing separate box in step 1, claim exempt from withholding in the space below, indicate their country of residence. You can just put that in the chat that I can't seem to see at the moment. Sorry. Where's my chat, Manon?
So if you move your mouse around and at the bottom of your Zoom application, there should be, oh, boy, isn't here the presenter.
So I know I'm like, I don't see it.
Up at the top of your screen.
Ah, there it is. There it is. Thank you. Okay. So you guys are good. Is that they need to check single or married filing separate in the box in step 1. Okay. Calculating non-resident alien tax withholding. Non-resident aliens have to claim additional income just for taxation purposes. They do not get paid this money and it does not get reported anywhere, but you have to include it in their taxation because they cannot claim any exemptions. So if you did not do this additional adjustment, they would likely not have enough money withheld from their check for what their liabilities are. So when using worksheet 1, percentage table method for automated payroll systems, the amount from table 1 or table 2, depending on if they are in a current 2020 or after W-4 or pre-2020 W-4. So if you're using the wage bracket method, the amount will be entered on line 1. So that's pretty straightforward, but we're going to come back to these numbers in just a minute when we get some examples. So our first example is Jorge, a non-resident alien who earns $500 a week, has 2018 Form W-4, so the prior to 2020, claiming single status, 1 withholding allowance, and written non-resident alien above the dotted line on line 6. Because Jorge is paid weekly, the employer adds $155.80. So let me just show you. This is the pre-2020. He's weekly, so there's where the $155.80 is coming from. So his total income that he's taxable on, I shouldn't say he's taxable, the total amount that we're going to find out what his taxes are is $655.80, the 500 plus the $155.80. The extra $155 is not entered on the employee's Form W-2. The employer uses the wage bracket method to calculate withholding. It will be used on the Form W-4 before 2020. The employer will go to the table for the weekly payroll period. Let me see if I can pull that up here. So I think everybody's familiar with these tables. So we would basically go down, sorry. So it's weekly, he's single, and his amount is $655.80. So he's going to fall right in here, and he has 1 allowance, so it's $57. So if we go back and look at this, find the row for wages at least $655 and less than $670, and then move to the column with 1 allowance. The employer finds $57 as the tentative withholding amount. Because Jorge did not request an additional withholding amount on the Form W-4, the $57 is also the final amount that you need to withhold. So that one was pretty straightforward doing that method. This next one you'll see is a lot more steps, but we got this. I'm going to pull this over for a moment just to show you. So this one, Allison is paid $23.50 biweekly. Hold on one second. On her 2020 W-4, she indicated she is a non-resident alien, claiming single or married, filing separate, and makes no other entries. So this calculation is kind of long and drawn out, but I just wanted to show you that this is the form that you actually would use. It gives you a little more detail, telling you exactly what you need to do. So we take the $23.50, which is the regular income, and let me back up. Whoops, hold on one second. Sorry about that. The biweekly single, I just wanted to show you from here. It's on the 2020. So biweekly is the $311.50. Oh, I'm sorry, $476.90. I had the wrong number. $476.90 over here. So that's going to give us a total of $2826.90, and because it's bi-weekly, you multiply that times 26 weeks for a total of $73,499.40. And again, that other form is going to give you more details on exactly what each step means. On the 8600, that is on the form. On 1G, if the box in step 2 of the W form is checked, enter 0. If the box isn't checked, enter 12,900. If the taxpayer is married, filing joint, or 8,600 otherwise. So we're going to do the $8,600. We're basically going to reduce the gross amount of $73,499 by the $8,600 to give us this new taxable amount, $64,899.40. So then we are going to go to, not that, sorry about that. Oh, goodness. I don't think I have this pulled up here. But basically, you're going to, you're going to go to the percentage table and find the amount, excuse me, $43,925 is what the limit is on that. You want to keep your $46,1750 as your amount that gets withheld. And then this next part is the difference between $64,899.40 and $43,925. You're going to take that amount times 22%, which equates to $46,1437. And then you're going to add the $46,1750 and the $46,1437 to be $92,31.87. And then you divide that by 26 pay periods, and that's the amount. The $355.07 is the amount that gets withheld. So I know it's long and sounds really complicated, and I would encourage anyone, once you get the recording, go through and get those tables pulled up and actually try to work through it. That's kind of how I started doing it, and it took a little time the first time or two, but once you understand and where to go and which forms to look at, it makes it a little bit easier. Does that make sense? Did I throw anyone way off?
No, it was great.
Okay. NRA tax rules. Again, NRA, non-resident alien. The IRS regulates non-resident alien income. Employee compensation should generally be sourced on a time basis, typically by day increments. And just to note, there are certain fringe benefits are the exception to the time rule. Alternate methods for sourcing income can also be applied where appropriate. And that is basically if someone had a job where their compensation was based on completion of certain tasks rather than the time that it took them to do it, that may be one of those situations where an alternate method can be used. Residents of Canada or Mexico working in certain industries and frequently cross the U.S. border are not subject to U.S. taxes when a written statement is provided to the employer. However, if you have a Canada or Mexico resident that is solely working in the United States, they are then treated as a U.S. resident for taxation purposes. They are subject to all of the federal taxes that a regular U.S. citizen would be if they're working solely in the U.S. According to the totalization agreements, non-resident aliens temporarily, which is typically less than 5 years, working in the U.S. are subject to Social Security in their country of residence only. Form 8233, exemption on withholding from compensation for independent personal services of a non-resident alien individual. This has to be set up, I'll read, it used only to claim a treaty-based exemption from income taxes and withholding by non-resident aliens, and it does need to be completed each year. If you have any questions on this, it seemed to come up in a lot of my study materials and my practice tests. Form 8233 is based on treaty-based exemptions for income tax. Tax treaties. The U.S. has entered into more than 60 income tax treaties with foreign countries that clarify each country's taxing jurisdiction to avoid double taxation of income. That is another key phrase that I saw a lot. The purpose of tax treaties is to avoid double taxation of income. So the benefits of tax treaties is it allow resident aliens to qualify for foreign earned income and housing cost exclusions under bona fide residence test, as well as the physical presence test. An employee's wages for personal services performed in the treaty country are partially or totally exempt from taxation by the foreign country if the employee is in a foreign country for a limited number of days and meets certain other requirements. Wages received by a U.S. teacher or professor in a treaty country are exempt from foreign taxes for temporary periods of up to 2 or 3 years. Amounts received by U.S. residents for study, research, or business and technical training are generally exempt from the treaty country's income taxes. To avoid double taxation, tax treaties provide for credits and deductions to reduce taxes imposed by the foreign country. Tax savings clauses provide that treaties do not affect U.S. taxation of its own citizens and residents. Therefore, most of the treaty's benefits related to a treaty's country's taxes are available only to U.S. citizens who are not residents of the treaty country and U.S. resident aliens who are not citizens of the treaty country. And this is really confusing. I found it confusing when I was first learning this. It's a lot to remember. Visas. The impact of visas on taxation on visa status. And I remember when I took the test, which was quite a long time ago, I believe this was the only type of question I got was on visas. And I don't know if anybody else that took the test more recently, maybe Rebecca, if you remember getting anything on the international payments besides visas.
I did have the question when it comes to resident aliens and how do you use that form 88?
Oh, the 8233?
Yes, yep.
Okay,
So
good to know. Okay, thanks, Rebecca. So in most cases, if an individual is eligible to work in the U.S., then the U.S. source income is subject to income, Social Security, and Medicare taxes. Some tax treaties may exempt portions of income from taxation. Certain students, scholars, exchange visitors holding F, J, M, or Q visa may not be subject to Social Security and Medicare taxes when the work they perform is carried out to further the purpose for which they entered the U.S. And I've been doing payroll a long time. The ones that I have seen pretty frequently and consistently are F1s, J1s, H2As. I actually have seen a lot of those. A lot of the others I've never dealt with, but I'm just putting it out there. I remember on my test, I think there was a question about a F1 or J1. Immigrant visas, which are the green cards, are issued to foreign nationals entering the U.S. as lawful permanent residents and who become lawful permanent residents. An immigrant visa is an I-551 permanent resident card. The non-immigrant visas or temporary visas issued to foreign nationals who wish to enter the U.S. for a specific purpose and will not be in the country indefinitely may qualify as resident aliens under the substantial presence test. So employers should not assume they are non-resident aliens for income tax purposes. And again, I would kind of look those over. There are different reasons. Where I lived there was a touristy area. So in the summer, we would get a lot of visas, which were sometimes students, sometimes cultural exchange visitors. And especially the temporary agricultural workers. We had a florist that had people coming from Mexico every year, the same people each year. So just something to think about and something you may encounter in your jobs. Pop quiz. All of the following conditions are required to qualify an expatriate for the foreign earned income or housing cost exclusion, except being a highly compensated employee, have foreign earned income, meeting either the bona fide residence or physical presence tests, having tax home in a foreign country. Can I get some answers in the chat? You're all scared of foreign income. I get it. Man, and you're right. Yes, it is A, being a highly compensated employee. That really has no effect on if they qualify. So good job, everybody. Important terms for understanding. When you get this, I would definitely give this a look over. Foreign tax home. This is the location of the employee's regular or principal place of business or employment. If there is no regular or principal place of business, the employee's tax home is where the employee regularly lives. And what I read on that too is if somebody has a home in the States or is there like for vacations and things, that does not count as their regular home. Bona fide resident test. This is the residence of a foreign country for an uninterrupted period that includes at least one full taxable year and where the employee considers home. Form 2555, foreign earned income, should be submitted by the employee with the personal tax return on which the foreign earned income exclusion is claimed. Physical presence test. This test is met if the expatriate employee is physically present in a foreign country or countries for 330 full days during any consecutive 12-month period. Foreign earned income is income earned by an employee from sources within a foreign country while the employee has a foreign tax home and qualifies for the exclusion under bona fide residence or physical presence test. Limit on the excludable amount. Qualified employees cannot exclude more than $107,600 of foreign earned income on 2020 or excess of foreign earned income over the foreign housing cost exclusion. The foreign housing cost exclusion, employees who have a foreign tax home and qualify under bona fide residence or physical presence test can take an exclusion for reasonable foreign housing expenses exceeding a base housing amount. The reasonable housing expense, some examples are rent, utilities, insurance, occupation tax, fees paid for securing a lease, furniture rental, household repairs, automobile parking costs. Interestingly, furniture rentals are included there, but if you're purchasing furniture, that does not count. So just be aware of that, or if you purchase a home, that does not count, only rentals. So base housing amount is $17,216 for 2020, which that equates to $47.04 as a daily rate. It's 16% of the maximum foreign earned income exclusion. Foreign tax credit or deduction is any method of avoiding double taxation of foreign source income. Expatriate employees may take a credit against U.S. tax for qualifying foreign income taxes. Claimed by completing Form 1116, computation of foreign tax credit, and including it with the employee's Form 1040. Pop quiz. For an employee to qualify for foreign income and housing cost exclusion, all of the following conditions must apply except must meet one of the tests proving the employee is not living in the U.S., must have foreign earned income, employee's immediate family is living in a foreign country, or has a tax home in the foreign country.
Sometimes I feel like it's cheating if I answer first.
You can be a cheater, man, and it's okay. Yes, employee's immediate family is living in the foreign country. That's not a condition for this. How are we on pace? Are we going okay? Anybody need me to slow down or speed up?
I don't know, but you might finish today.
I know, this is it's pretty straightforward. Man, and you have to tell jokes or something to keep us time.
I think Melissa is better at jokes.
Yes, Melissa, you have jokes?
No, I don't have, well, I have jokes, but I was just gonna say I did have I think 2 questions on my CPP exam on the foreign housing cost exclusion. So knowing
Oh,
those
yeah.
rates, that is one thing I had on my test. So just a heads up on that.
Yes, and I did actually see that, like I said, taking sample tests and things within PayTrain. This 107,600 was definitely in there. And the other thing was the base housing of 17,216. And most of the questions I got were actually the daily rate. And so if you remember it, like when I did it, I was like, I know it's around 17,000. So I did the math and came up with it that way. But you really should remember those numbers. So thank you for saying that, Melissa.
Sure. I'll come up with some good jokes though.
Great. Totalization agreements, Social Security and Medicare taxes. Expatriate employees working temporarily in the foreign country, generally up to 5 years, are subject to U.S. Social Security and Medicare taxes only. Wages earned by employees working permanently in the foreign country are subject only to the foreign country's Social Security taxes. In either case, Social Security coverage must be established with the Social Security Administration. That was another question that I saw on the sample test, was that it was who determines, like who manages this, and this is the Social Security Administration. There are 29 countries with totalization agreements, and Form 2032 contract coverage under Title II of the Social Security Act. So just typically, if it's under the 5 years temporarily working, then they'll have U.S. Social Security and Medicare taxes. Employer tax reimbursement policies. In general, most compensation and tax reimbursement policies are designed to ensure the employee will not have to pay combined taxes on income in the 2 countries exceeding the taxes that would have been paid if the employee had remained in the U.S. It's basically, you can't send somebody to another country and expect them to pay a lot more in taxes because there's no incentive there. Alternate compensation is typically provided to employees to ensure that a standard of living comparable to what they would have had if they were still living in the U.S., taking into account the additional taxes. Tax protection plans. The employee will be reimbursed by the employer to the extent the employee's combined income and Social Security taxes in the U.S. and the foreign country exceed the amount that the employee would have paid if living and working in the U.S. Tax equalization plans. The idea that The idea is that all expatriates should continue to incur a tax burden equal to what they would incur if they were living and working in the U.S., regardless of the actual foreign tax liability. Hypothetical taxes. Whether an employer uses tax protection or tax equalization to reimburse an employee for higher foreign taxes, the employer must determine the tax that the employee would have paid if the employee had remained in the U.S. This is known as hypothetical or stay-at-home tax. So basically, in order to make sure you can credit someone if they're having more taxes taken out, you have to at least figure out what the U.S. taxes would be. So that's going to be your hypothetical taxes. Shadow payrolls is a mechanism which facilitates local tax withholding for an employee who's working abroad but remaining on the home country payroll system and is paid under a tax equalization plan. It is called a shadow payroll because the employer pays the host country taxes on behalf of the expatriate employees, and often the employee doesn't see these calculations. And in a past job, we actually did shadow payrolls for one of our clients every month. They would handle everything, the client would handle everything on their end, paying the foreign countries and things. And basically I was just putting it in the system so that all of the taxes were paid, but the employee did not technically pay those taxes. They were paid by the employer on behalf of the employee. Pop quiz. In order to ensure an expatriate employee will not be overburdened by foreign taxes, an employer might offer any of the following tax plans except tax protection, hypothetical tax, foreign tax exemption, or tax equalization. I like we have different answers. Foreign tax exemption. Hypotheticals where you kind of have to calculate and figure out what the U.S. taxes would be. And it does, when you have the rationale, The foreign tax exemption allows an expatriate employee who is subject to U.S. and the foreign country's income tax to credit the foreign country's income tax against U.S. federal income tax withholding. It's a lot of words. Most employers with expatriate employees, U.S. citizens and resident aliens, will have plans that reduce the income tax burden the employee faces. The plans an employer may have included tax protection, tax equalization, and hypothetical tax plans. Currency conversion. The exchange rate is the rate at which one currency will be exchanged for another. It also is regarded as the value of one country's currency in terms of another currency. Each time an expatriate employee is paid, the conversion occurs requiring the use of the interbank exchange rate. It's an interesting example to me because it sounds so much better to be in Japan. An interbank exchange rate of 112.64 Japanese yen to the US dollar means that 112.64 will be exchanged for each US dollar, or that $1 US will be exchanged for each 112.64 yen. So an expatriate employee earning 3,000 US dollars working in Japan, paid in Japanese yen, would be paid 337,920 yen. So it just sounds better, it looks better. I want to be paid that much. I know it's the same number. Managing international relationships. Each organization will have their own methodology for managing relationships with third parties. One common method is through service level agreements. And when I was talking before about the foreign client that I had, we did have service level agreements in place, and it'll make more sense in a moment, but it was like what the expectations were of the payroll service provider and what our expectations were of them, and how it all works well together. So a service level agreement, an SLA, is a contract, whether with an internal organization or a third party providing services, identifying the expected services or performance that will be provided. Commonly, SLAs identify expectations for performance, problem management, responsibilities of both parties, etc. So if your SLA says you're required to give us 4 days notice to do X, Y, and Z, and they give you 3, you then have a leg to stand. You can say, okay, well, you didn't fulfill your part, so now we might need to change things. It's just basically keeping the two parties in check and making sure you're following all the rules that you set forth at the very beginning. Service level agreements are written specifications that set out in detail the level of quality and service to be provided by one entity, the service provider, to another, the client. The entities may be different departments within the same organization. An example, services, the payroll department will provide to other departments, or different organizations, a company to which payroll processing has been outsourced. Pop quiz. Foreign citizens working in the U.S. who are generally taxed by their U.S. employer on their worldwide income are considered non-immigrants, expatriates, resident aliens, or non-resident aliens. So foreign citizens working in the U.S. Who are generally taxed on their U.S. employer on their worldwide income. I hate the wording too, Rebecca. It's very confusing, and it's very wordy. It's a lot of information. So it's resident aliens, and the key to that is it's on their worldwide income. So resident aliens and U.S. citizens are generally taxed on their worldwide income. Non-resident aliens are only taxed on their U.S. source income. The taxation of non-immigrants depends on their resident or non-resident alien status. Expatriate taxation depends on their status, U.S. citizen, resident alien, or non-resident alien. So it is very tricky. One of the things that I kept seeing, again, all the practice tests, was the difference in the wording of worldwide income versus U.S. income. If they're talking worldwide income, it's a resident alien, and non-resident is when you're just talking about U.S. income.
So
Oh
you
my
said
goodness.
worldwide was resident alien,
Worldwide, and when they're taxed on the worldwide income, yes, that's resident aliens.
and non-resident is U.S.
Is U.S. income, yep.
Okay, and then how are expatriates taxed? They're the ones that are a U.S. citizen working in a foreign country, and they're using theoretically one of the like tax
Yes, one of the different tax
benefit
options.
hypothetical foreign or hypothetical tax
Yes.
protection or tax equalization.
Yes, these four options here, the tax protection, tax equalization, hypothetical, or shadow payrolls. So it's a lot. And the good news is that you're going to get very few questions about foreign income tax on your test. That's the best part. It's very confusing.
Okay.
Any questions? Any jokes from Melissa?
What did the 0 say to the 8?
What did the 0 say to the 8? I don't know.
I used to be a math teacher, so I have a lot of nerdy math jokes. Sorry.
I don't know.
Nice belt.
Wow.
Oh, goodness.
Nice.
Sister that's a math teacher, I have to make sure she knows that one. That's cute.
I learned so much being a teacher. It was incredible.
Right? It's good times. All right. Are we really done?
Okay. Yeah, but
Yeah.
expatriates versus resident aliens.
Yes.
They're very similar, aren't they?
They are very similar. Expatriates, let me see if I can pull something up on my other screen here. From, sorry, so many things open. Can I move you guys over here for a minute?
Yeah.
Sorry, I'm just looking for something in the page train that might better explain it than me.
Expatriates.
Here, can we pull this over or am I gonna get in trouble?
No.
Okay. I don't want to like read all this, but there was something in here that I thought.
U.S. citizens and resident alien working in a foreign country are subject to federal income. No, that's not it.
Because let's see, in general, wages earned by U.S. citizens are. Is that what you were just reading it down here?
Mm-hmm.
Withholding. Whoops, let me move this again. Wages subject to foreign income tax withholding. The employer is required to withhold federal income tax from an expatriate's wages if the employer is required by foreign law to withhold foreign income taxes from those wages. The same is true for U.S. possessions. But the tricky part is just where all of the tax exemptions apply, because it could change. So a mere agreement to withhold between the employer and the employee is not enough to support the exemption. The withholding must be required by foreign law. A signed statement attesting to the foreign withholding requirement should be kept on file by the employer. Employees working for U.S. companies abroad are generally subject to Social Security and Medicare, although coverage is optional if the employer is a foreign affiliate of the U.S. company. So my understanding, and I can always put more information out once we release this, but the expatriates do also have the taxes, the U.S. taxes without Social Security and Medicare, as long as it's within, I believe, the 5-year temporary. But the part that I will have to look a little more and get back on is those special tax credits, if that changes their taxability, because I know they can reduce their taxability by the housing costs and the foreign earned income. So we can get a little more information on that. Oh, hold on, let's see. Okay, that's resident aliens. Okay. So is it okay to put that, Manon, in our, when we send out the recording, to include that as a follow-up?
Sure.
I certainly don't want to say the wrong thing.
Yeah.
All right. Unless anyone on here can answer it differently. But I would rather look into it a little and not give a quick answer. Okay.
All right, Kate,
Anything else?
you really.
I didn't feel like I was going super fast. Jeez, apparently I was.
It was a really short chapter.
Right? And I think it's because there really aren't many questions on it on the test. It goes pretty quickly.
Yeah. And so we have one more module to cover. And Kalisha is going to do that next week. And then our final week is just kind of taking a look at how the test is typically broken out. They send out an outline of, okay, 7% of the questions are going to be on this, and 8% are going to be on this, and 30% are going to be on this. So we'll see what those breakouts are projected to be for everybody's exams. And then we'll review all of our test tips and do a couple of practice calculations in that final week. So I know we're kind of cutting it short this week, but we're going to review everything in that final week to make sure. I mean, I want to do that too, so I feel more practiced and prepared for my exam this fall. Okay, great chat, everybody.
All right. Are
So
we all
does that
set
mean
then?
we're done for the week?
I think so.
Yes.
That is fantastic.
Yeah.
For me too. Just kidding.
Nice job, Kate.
Yeah.
Thanks, Rebecca.
You're welcome.
And Man and I will get back to you on that follow-up question.
Okay, great. Thank you.
All right. Thanks, everybody.
Okay, bye.
Bye.
Bye.